Well, if they postpone them, it would be the move in the right direction. If you look at the world trade figures year to date, in terms of dollar value, they're down 2.8%. And if you look at the World Bank forecast for this year's world GDP at 2.6, it has dramatically slowed. This is the lowest level since 2009. And obviously, the United States is going to slow from about 2.5 to 1.7 in real GDP. So unfortunately, these trade barriers are deleterious both to the United States and to the world economy as a whole.
But Scott, given the fact that the selling, at least today and really since the start of December, 2 days, right, has been pretty broad-based, do you see opportunities? Is there value to be had right now in this downdraft?
Well, the overall market's expensive. If you look at the S&P based on $166.60 next year, which is up 5%, it's around an 18.5 multiple. It's not cheap. And the Russell 2000 and the 2500 are selling over 19.5 multiples. So you have to do item selection. There are individual names that are cheap, but as a homogeneous group, the market is really fully priced at this point.
Charlie, clearly you're bearish on the impact of these the potential for the trade war to escalate again. That said, do you take any comfort in the fact that the president has said this when we're really near all-time highs, when consumer data, retail sales has been strong, and that we saw him pivot quite clearly a year or so ago when the market did tank and the data did tank meaningfully? Does that encourage you that he's not going to push this to the brink?
Yeah, I think that is the most encouraging thing. We have seen this before. We do know he's a negotiator. He has often in the past said things to try to get a movement on the other side. That's the optimist in me. But we are close. It's December 15th. It's not like we have a lot of time here. And this, we had such positive things coming out. That was what was so startling. All of the comments had been about we're planning the event. We're looking at our calendars. Today was the first time that things looked really seriously worse.
But the fact that, and Bob Pisani just laid out 3 different scenarios that could all basically take place over the next week and a half. As an investor, they're all very different. How do you position yourself coming into that?
Yeah, I think you have to look at what the market is anticipating. The reason we've had such a great year in the stock market this year is because a year ago, everybody was very worried about trade tensions and about a recession in earnings and a downturn in the U.S. economy. We've done so well this year because a lot of those problems went away. And so my only concern at this point is people are now feeling pretty good about things. They're feeling pretty good that Brexit's not going to be that ugly, that we're not going to have a recession, that we're not going to have a trade war. All of a sudden, the assumptions seem pretty positive. If one of those goes the other way, we have some exposure.
Scott, the banks had a great October, November, but have pulled back significantly at the start of this month. Is that a buying opportunity?
Not yet. I mean, we own J.P. Morgan and Morgan Stanley, Goldman Sachs, U.S. Bank. We've owned them a long time, and they've done well, and they're cheap relative to price to book. But as the yield curve flattens, that's not good. And as you know, for the bigger banks, they're dependent on investment banking deals and private equity, et cetera, and the deal flow is down. And so overall, you're not going to have good growth in earnings next year, and they're all like 12, 13 multiples. I think Goldman's a little less, selling below book. But I think if we do have this trade war, I think you still have to lay off the banks as the yields decline in here. I would not be buying them at the margin, as they say.
So, Scott, if not the banks, what do you like right now? What are you buying right now?
Okay, I've got an oddball tech company called Ciena. It's a $36 stock. They're big in optical switching. They're the dominant force with a #1 share in the United States. They do no business in China, so you have no exposure. As I said, they'll earn close to $260 for the October fiscal next year, which is a 13 multiple. They have excess cash on the balance sheet of about $140 million. They generate nothing but cash and earn close to 17% return on equity. As I say, at a 13 PE, I think it's a good value, and the earnings will be up nicely, $260 next year against $215 this year. For people who are looking for yield, okay, that aren't desperate. Go ahead. I have another one. It's located in Boston. It's Bain Capital Specialty Financing. It's a $19 stock. It's a BDC, Business Development Corporation. They'll earn about $1.70, which is an 11 PE, has an 8.5% yield. The stock is selling at 96 cents on the book. And there are no bad loans and almost minimal exposure to energy. There are about 130 portfolio companies. The average loan is about 19 to 20 million. They've never had a default. And you know that Bain is a very well-run company. So I think this is an interesting play where you can get some yield without having to worry about sleeping nights.
Scott, thanks so much for joining us. Great to see you as always.
Thank you for inviting me.
Charlie, any of those, as a fellow value investor, any of those stand out for you?
You know, the last one was more of a yield play, and I'm very nervous about people stretching for yield right now, particularly after today, where the 10-year was starting to act like it was getting to a reasonable level, and now it's dropped back again. So these yield bond substitute stocks make me nervous.